in the process of investing. Send in your queries using the hashtag AskBQ to BloombergQuint.com. Write to us now. Use the word Ramdev in all your queries.
Good morning. This is Bloomberg Quint, India's first live streaming business news service. I'm Menika Doshi.
And I'm Neeraj Shah, and you're watching IndianOpen.
Good morning, everybody. These are the headlines. Asian markets tread with caution after Wall Street posts its first declines in more than a week. Big earnings today. HDFC Bank and Infosys are two of the 5 Nifty companies which will report. And 5 steel giants and the Ruya family put in bids, express interest in Ersa Steel's stressed assets.
Well, and that could keep a lot of these smaller companies excited as well. But let's take a look at the trade setup for the day. It's a heavy earnings day, heavy earnings week, I might add, and not just for India, for the world at large. I think globally, the likes of Alphabet, Twitter, etc., all come out with numbers. But what's looking like for the markets today? Maybe a somber start, maybe a flattish start. I would not use the term somber, quite frankly, because as the headline stated, Wall Street had the first decline in the last 6 or 7 odd sessions, and that's showing in the way the rest of the Asian markets are trading as well. So we have a flattish start at hand. The SGX Nifty has shown that hand, so about 10 or 11 odd points. But you'd probably assume it could go either direction. So a flattish start is what we could have. The good news is from an index watcher's perspective is that banks have finally started to participate, or at least seems like they are participating. They did participate in the last half an hour, 45 minutes of trade. And quite frankly, if you look at the intradays of both the Nifty Bank and the Nifty, they are identical in the last 1 hour. The Nifty Bank moved up from the red into the green, about 1/3 of a percent, and that's what the Nifty did as well in trade yesterday. So pretty identical charts. The Nifty Bank led the index higher after Reliance and the telcos had done their bit. High delivery in all key index gainers yesterday. So I was looking at the delivery percentages, be it banks, be it Reliance, be it the other telcos, pretty high. HDFC Bank 66%, ICICI Bank 64%. So the gainers moved up on pretty strong delivery volumes as well, which was good. The only difficulty, if you talk to traders as well as market participants alike, is that the telco rally now is so strong and has been lasting for such a long time that you'll probably believe that there'll not be a repeat of what the telcos have done in the recent past, and therefore the others need to participate. Read banks, quite frankly. What to watch today? It's a heavy earnings day. 5 index stocks release results. I think 3 of them come out during market hours. We'll have Infi, of course, come out post-market hours. Ambuja probably, and Encore as well, post-market hours. But you have Asian Paints, HDFC Bank, and towards the fag end of trade, Z Entertainment coming out with numbers. So that's an important number. But a clutch of mid-caps and non-index important names as well. I think people will be watching out for Canfin Homes. Some stress seen in housing finance companies and Canfin in the last quarter. Whether this quarter will be a repeat remains to be seen. And ICICI Pru would be keenly watched out for. Bajaj Finserv in its commentary mentioned that life insurance was the segment that didn't do quite well for them. Let's see if ICICI Pru manages to do better or no. And not too many stocks, unfortunately, at the in the reaction list today. An odd S chant because HDFC MF bought, or clutch of small caps, Oriental Hotels, good numbers, automotive stampings, bad numbers. And Indiabulls Housing Finance will probably not be a big reaction. So not too many stocks that will react this morning on news. But yeah, during the course of the day, a bunch of earnings, so we'll watch out for all of those.
Yeah, earnings is really what's flooded first word this morning as well. A bunch of previews and what to watch out for. And then, of course, we've got that big story, steel story. So let's start first with what we have for you on first word. Infosys, first quarterly earnings after Praveen Rao took over as interim CEO. But more importantly, after Nandan Nilekani came back for a second stint at the IT major. We'll be watching those numbers closely and also waiting to see if there is any announcement or indication on that CEO search that is underway. Will HDFC Bank manage to post another quarter of 20% profit growth? Well, I'm not going to try and answer that question. The SR Steel resolution process promises to be a potboiler as 5 metal majors and the Ruyas themselves express interest in the debt-laden company. We'll discuss a little bit of that. And Reliance Nippon AMC gets set to become India's first listed asset management company. We take a look at its valuation and how AMC should be valued. All of that is lined up for you over the next 20 minutes or so. But let's start first with Infosys this morning. Ahead of its September quarter earnings, what can we expect from the IT major? Agam standing by with that. Agam, margins?
Margins, but this time around, it isn't going to be about earnings. It's going to be about guidance and, of course, the strategy and the CEO. But let's get expectations out of the way.
Okay.
We're expecting 3.5% growth sequentially in terms of dollar revenues, rupee revenues, seeing similar 3.5% expected growth. Margins are expected to come off to a certain extent to around below the mark of 24%. Consequently, profits could only see a growth of around 1.3% sequentially. But the big question is, can we expect a guidance cut? Now, the management has given a guidance around 6.5 to 8.5% in constant currency terms for the full year. However, UBS is of the opinion that the top end of the guidance cut has already been factored into Infosys price, and UBS, Kotak, as well as IDFC, all are of the opinion that a complete downward revision of the guidance cannot be ruled out. What is it that's going to bear down on earnings this time around? Well, we know the usual. Softness in BFSI and retail. And of course, there's pricing pressure that has been coming in for Infosys specifically. And we will be looking at wage hikes, and a lot of these wage hikes have come into effect in July. So that could also bear down on margins. But the real question, something that all investors are keeping an eye on, is whether or not we will see a CEO announcement. This morning, we had a newspaper suggest that the Infosys could actually announce a CEO as well. There are two contenders out there. Of course, we're also looking at client spending and budgets, but no one's going to care about that one. Of course, the other very important factor will be the strategy. Now, we're most certainly going to see, how Infosys charts its strategy out, and those are some of the key factors to keep an eye on. Of course, other than the fact that whether or not there could be change in guidance, but it'll all be about strategy and the new CEO.
I mean, the one place where I differ with Agam ever so slightly is that last con call, Agam, almost every analyst that I heard on the con call was asking Nandan one question: what are clients saying with this whole transition that is happening, and if Vishal and the team is going out, what will client reactions be? So maybe that could be something in focus as well, right? I mean,
but Neeraj, somewhere in the mid-quarter, the CEO, that's the interim CEO, had gone to the US and they had spoken to a lot of clients. And after that, they had another con call and they had suggested that for now, clients are happy. They want to remain with Infosys. And of course, then the big questions that I've already spoken to us in the preview.
No, look, I mean, I think for me, it's less numbers. It's the first quarter since Nandan took over. I can't imagine clients not having confidence in a Nilekani coming back to Infosys. You can't have a better person there, despite all the other concerns we may have about how this company keeps turning back to its founders. But today is not the morning to talk about that. I'm just curious to know whether analysts will be looking at the numbers and the minutiae in the numbers as closely as they will be looking at some of the points that Agam put out there. The strategy, the ability to find the right kind of CEO. Will the CEO be someone new coming into the company? Will it be an old Infosys hand, as has been rumored for several weeks now? I think those things will shape the expectations from the company and its performance.
If I may come in here, the paper suggested Ashok Vemuri and BG Srinivas.
That was Business Standard. Yeah, but I think both these names were in the play the day Nandan took over, right?
Yes.
Yeah, I mean, just the very the
and
day.
they have been along with CEO for with Infosys for a very long time.
Absolutely.
And they seem.
And if I remember correctly, Agam, I don't remember the dates very correctly, but they both left when they realized that the position at top had been taken over by
Vishal Sikka.
Vishal Sikka. And so therefore they had, obviously Vishal was not going to leave anytime soon. Nobody anticipated then that he would leave as quickly as then. Right. So they assumed that for the next 5, 7, 10 years, they didn't have a shot at the top. So maybe now there is, there's a difference there. But I think, to me, those factors will shape the expectations on the company a lot more than whether margins move down to 23 point something % or not. I'm not sure that's going to be the big watch. But let's get an expert voice on this.
Yeah, Sanjeev Hota, Assistant Vice President Research at Sharekhan, joins in on the conversation. Sanjeev, hi. So we four out here in the studios have our own watch points. What would you be watching out for the most? The delivery, the margin picture, client confidence, or the commentary? Or actually the new CEO? I'm giving you a lot of options.
Good morning. First, for the Infosys, I would like to hear the commentary because I don't really think that earnings may surprise in this quarter. So earnings is already in the price. So what is important for Infosys is the commentary going forward. And so what is first important to look for is that recruitment of CEO. I don't really think that is going to happen today and we will have to wait for that. But that's the first priority for Infosys, to get in a good CEO to lead the Infosys. And second is the strategy. And coming to the strategy, I don't really think Nandan Nilekani has any leeway to go beyond what Dr. Sikka has implemented in Infosys. Digital, foregoing the premium pricing. So these two things, I think Nandan Nilekani has to follow, because they cannot go back to the premium pricing. They cannot forego the digital initiative. So these two things going to be there. Beyond that, what Nandan Nilekani is going to do, that need to be checked. But I think interference of founding member, I think, need to be restricted to give a full hand to the new CEO. So commentary on this part is, I think, I would look forward to. And secondly, what is the commentary on the BFS? If you see Infosys in the last 6 quarters, the company growth was muted at around 1.6%. BFS has been muted, but insurance is on the better side, is going much better than the company averages. So what is the commentary on BFS? Because TCS has commented that it's still not out of woods and has anticipated in the start of the year that BFSI is going to ramp up. It is not happening. So what is the commentary of Infosys on BFS and also on retail? Because there is a contradictory statement that has came out from TCS that retail has bottomed out. And that like to see uptake in H2. So retail and BFSI is still contribute around 40%, 45% of Infosys. So what is the commentary on this?
I agree with you.
Important
so
Infosys.
that would be very important. But if you were to watch out for one number, Sanjeev, in terms of the delivery for the quarter, what would that number be?
I think again I would like to see the volume numbers, because anyway pricing is not in Infosys hand. It is going, if you see last 9 quarters, 6 quarters, pricing was down, offshore pricing or blended pricing. So pricing I don't think in the Infosys hand, but I would like to see what kind of volume numbers they are going to deliver.
Well, we'll be watching for that as well. Sanjeev, thank you so much for joining us this morning. That's a quick expert heads up on what to expect from Infosys. We'll be watching the numbers as closely as we'll be watching some of the macro conversation on that company. Hira?
All right, HDFC Bank also reports today. Not much to anticipate in terms of volatility in their numbers. Their greater delivery. But there are some interesting factors. Shraddha Babla is first joining us with the estimates from the brokerage houses. Shraddha.
Well, to start off with, Ira, like you said, no surprises expected here. You have banks like Kotak, Indus and HDFC. You're never really surprised positively or negatively there. But if you look at the key numbers, net interest income is seen growing by 20% to 9610 crores, and net profit growth is likely to come in at 20.7% to 4171 crores. That's, of course, your Bloomberg consensus numbers. And 20% sort of a number is something that HDFC Bank has been delivering over the past few years. If you look at the net interest margins, they are expected to come in stable sequentially at about 4.4%. Remember that savings rate cut did come in the second quarter itself, so that should aid margins to some extent. When it comes to some of the other parameters like loan growth, expected to come in at about 22%. Broadly, you will have the higher working capital demand, the growth in unsecured lending, and also the traditional retail portfolios like auto on account of the early festive season, which could aid that loan growth. Gross NPA is expected to remain stable around 1.24%. Do remember that in the June ended quarter, the gross NPA number had seen a spike of about 19 basis points sequentially, mainly on account of the slippages in the agri portfolio owing to the farm loan waiver. So that's one aspect to watch out for. Broadly, we will also be looking out for the kind of performance in the other retail portfolios such as the CV, CE segments. That apart, we will also be watching out for the trends, broad trends in digital banking payments, and also the overall balance sheet outlook and economic recovery comments. But overall, steady quarter, no surprises expected from HDFC Bank.
Pretty much.
What are you expecting?
No, I mean, pretty much the same. The only thing I'd watch for is the CASA numbers. I think last quarter they reported a drop in the CASA percentage.
As much as 400
exactly. So I don't know if that was a one-off as money was moving into mutual funds, etc. I mean, it round trips and come back to banks.
I think they said that usually Q1, that's what happens.
But it was at a multi-quarter low. So even if you compare it to last year Q1, it was lower than what last year Q1 was. I mean, some of money was moving into mutual funds and other instruments like fixed deposits, perhaps. May just be a one-off thing. They know how to maintain their CASA. So I think that should be fine. And as Shraddha said, any commentary on retail, on credit cards, since there's aggressive competition there, worth watching.
All right. That's the story on HDFC Bank. We'll know later this afternoon. Let's move on to the next big story that we have coming up, and that has to do with a Bloomberg Quint exclusive filed by our colleague Vishwanath. There are many takers for Ruya Group steel assets. Bloomberg Quint's Vishwanath Nair has learned that 5 metal giants have expressed interest in SR Steel, which is currently undergoing the insolvency process. The bids closed yesterday. Vishwanath joins us with more on who the players are and where the process goes from here on. And a quick reminder that the Ruyas are the 6th one that have expressed interest in this. Vishwanath?
At least 5 large metal companies have put in their hat in the ring for SR Steel's resolution process. Now, as of Monday, there was an expression of interest that had to be submitted in the SR Steel case, according to an advertisement that was put out by the resolution professional in this matter. This expression of interest was to submit a resolution plan later on in the coming few weeks. The 5 large companies that have submitted their expression of interest include Tata Steel, Steel Authority of India Limited, ArcelorMittal, Sumitomo Corporation, as well as Vedanta PLC. Now, apart from these 5 large investors, there was also the Ruya family, which is the promoter family for SR Steel, which has submitted its expression of interest for a resolution plan in this case. Now, SR Steel, if you remember, it became a part of the insolvency and bankruptcy process in August, when the National Company Law Tribunal had admitted it under the Insolvency and Bankruptcy Code. What will happen now is that on the basis of this expression of interest, the Committee of Creditors will meet with some of the investors who are serious about actually investing and trying to turn around SR Steel, and together they will come up with possible criteria on which some of these resolution plans will be based on, and the final resolution plan by each of the investors who are actually interested in finally submitting a plan will be done by the mid of December. That is what our sources are telling us. After the submission, the Committee of Creditors will look at these plans and then select the best possible plan, whichever suits their idea of the valuation of SR Steel. Now, this is an important step in the whole insolvency and resolution process that has been initiated in large cases by the Reserve Bank of India in June, when they put out a list of 12 large cases and sent it to banks and asked them to take immediate action, immediate insolvency action in these cases. These 12 cases put together contributed about 25% of the banking system's gross NPA as of 31st of March 2016. And SR Steel is one of the largest companies among the 12 which was sent for immediate action under insolvency.
All right, Vishwanath there with the details on that story. Important story, bunch of takeaways from my perspective. One thing is that you have some interesting strategic names in there.
All strategic. That I thought was most curious. That's what I was talking to Vishwanath about last night. Right?
Yeah, so we saw some of these other stocks, steel stocks rising as well. Yesterday you were pointing that out, midday, Bhushan Steel, Uttam Galva, etc. The fact that these international guys are in the fray probably suggests that there is interest, and maybe the pricing on some of these stressed assets could be better. So while it was always expected that there will be interest in the steel assets, it was the power assets that were more troublesome. But if you have Arcelor, Tata Steel, Sumitomo, I don't know why SAIL is there, because SAIL has no money of its own. But perhaps it's just an expression of interest. So a lot of people go through these M&A processes to sort of information fish. That's always been known. I think the second interesting point, and I will not take credit for this, is an interesting debate that was going on Twitter between economic commentators, well-known economic commentators, Avinash Tripathi, Karthik Shashidhar, all of whom were questioning as to what happens when a promoter entity comes back into an auction like this. Now, it's completely fair game, I guess. An asset goes up. The promoters, who at some point did not put in money, did not put in additional equity, will now have the chance to put in fresh equity and buy these assets. But is there an information asymmetry between people who have been running this business? Exactly. Who have been running this business and those who have not. So, while memorandum of information will be floated, etc., but nobody knows a business like the promoters. Now, that can be good and bad. It can be good because they probably have the best way to, or best understanding of how to turn it around, but it can be bad because they have an advantage over other bidders.
Okay. So let me add to the Twitter commentary. I spoke to a bunch of lawyers last night after Vishwanath broke the story, saying, how does this go from here? because this is the first large insolvency process that we're seeing, right? 44,000 crores in debt. Guys, that's not a piffling amount by any stretch. Nobody knows. What will the IM have, the information memorandum? Nobody knows. Will there be site visits? Nobody knows. Will there be a data room? Nobody knows. So everybody expects this to run like any other ordinary M&A process will run.
Yeah.
They've expressed interest. Now these potential bidders will get access to all the diligence they need to do to be able to come up with an actual resolution plan. SR Steel is unlisted. There is very little public information from the last 2 years that it went unlisted in out there for the bidders to actually use to evaluate the asset. Ownership, sort of the web of ownership, if I may call it that. And there may be no web, but just to be clear, who offers the reps and warranties in a deal like this when you actually go in there? Who offers the assurance that the data is being put up? Because the data is being provided by the resolution professional. So who
is dependent on the management of the company at the end of the day?
To get the
information. The board may not be active anymore, but who is the resolution professional depending on?
He's going to get it from the company,
absolutely.
right? So who offers the reps and warranties that normally a seller offers, saying, hey, the data we're providing you is authentic data?
Yeah.
The IRP can't offer it on behalf of the company. Is the company going to offer it? Is the NCLT going to offer it? So that part of the process is fascinating, and exactly the point Ira brought up, saying, does the involvement of the Ruya family in this simply only just complicate the process? Can you be cynical enough to say it might vitiate the process? And I just want to add one more thing here, Ira. We don't know what restructuring plan the Ruyas and the banks had come close to working out, right? I say close to working out because I don't think it was ever finalized.
Yeah, they said
in their petitions, they had said that they were close to working it out.
Yeah.
Will this bid, whatever the bid is, and whoever puts in the winning bid, will it have to be better than that whatever that restructuring plan is? Because otherwise, what was the whole process of doing this? Will we ever know if it's better than that restructuring plan? Because the restructuring plan is not in public information at all. Will it be worse? Will the lenders ever let us know whether, they could have gotten better terms then or they got better terms now?
Yeah. And I think that's where the desperation of the lenders to get particularly, these large steel assets off their books will come in. They are hopeful that people like Arcelor, etc., will have perhaps stronger bids to put in, but you don't know that for a fact. Also, there are a lot of steel assets in the market now.
Yeah.
There are strong steel assets in the market now, and the lenders can't afford to allow a lot of these assets to go into liquidation. I mean, you just cannot.
No, you don't
the amount on the dollar that you will.
Right?
No, apart from that,
with maybe poor managements.
I mean, not moralistic, but in terms of just amount that you recover, what are you going to do? As somebody said, jokingly, you're going to go put out boilers for auction? No, right? I mean, you're not
going to sell this pennies to the pound, right?
You're not going to want to go into liquidation, which means that if the other bidders are not particularly aggressive, and if the Ruyas are the only ones on the table putting the money, you will give it to them. There is going to be no moral argument there as to whether.
But there shouldn't be, right? At the end of the day, this is recovery.
There, I'm not entirely sure.
I get the perception issue, right?
Yeah.
I get if after all this it goes back into the hands of the Ruyas, people will wonder what is this process worth.
Yes.
But if I may also add here, and rarely does anybody play. Devil's advocate for Ruyas or large business families. But I was wondering, what if they came back with an aggressive bid? How would then they explain to banks that they couldn't resolve the debt 3 months ago?
Exactly.
But don't forget that they're in a slightly different financial position today than they were 4 months ago because they've concluded that SR Oil deal. They managed to delever promoter entities. So today, if they want to get in, let's say a financial investor, etc., a financial investor or some form of creditor consortium backing them might have a little bit more confidence, little bit more, okay, I'm guarded with my words, than they would have had three months ago.
Sure.
Keeping in mind the fact that this is a company that has gone through now 2 restructuring processes. I mean, of course, they will justify that saying industry, etc. But, the fact is that it's gone through CDR, it's gone back into various restructurings.
No, I agree with
there
all
are no
of
public shareholders here, so, it's easier.
But that's what makes this such a fascinating process, right? I mean, this one is going to be the trial by fire of the insolvency and bankruptcy code, and man, it's going to be fun to watch every twist and turn in this, right? Okay, enough about steel.
Yeah.
We have another very interesting story picking up, IPO, which will open tomorrow, right? Yeah.
Yeah, it's interesting
India's
because
first AMC.
India's first AMC. Yeah. So, guys,
from the Ruyas to the Ambanis.
Yeah. Well, yeah, one Ambani at least. And, I just divided this into three, quite frankly. One, the positives, if at all, concerns, and the valuations. Now, there's no point in going through the positives in detail because everybody knows this whole story, right? I mean, one, that it's one of the top 5 AMCs. So in that sense, it's got leadership. It's been around for years now, so it's got multi-cycle existence, experienced hands running the show, even though there's been a change of sorts. But the people who've come in, Manish Gunwani is no mug. I mean, he's an experienced hand as well. Diversified product offerings, so on and so forth. And this whole thing of this financialization of savings, I mean, I can throw some 10 numbers which are new to the already 50 or 60 existing.
And I can throw 10 numbers to say that none of this is proven. It's all assumption.
No, but I mean, you'd probably, equity AUM just moving up. No, I mean, equity AUM just moving up is probably one quick sign, right? I mean, here's a number, 1.98 lakh crores 2013 to 6 lakh crores, equity AUM 2017. So that's a strong growth. But I just thought I'll focus on a couple of things. One is, if at all there are concerns to this story, because if you look at what the anchor investor subscription is going to be, you would presume that investors are not seeing any concern. It will be subscribed some multiple times.
Okay, let's discount that for a bit.
Yeah, let's discount that for a bit.
We all know how IPO process is run in this country.
Yeah.
So
I just thought, I mean, one, that the valuations that it is coming at, even though it's cheaper than the round that Nippon bought in, but if you just look at it, compare it to NBFCs, even though it doesn't look cyclical, AMC business is cyclical and it's asking for valuations. Reliance AMC, Nippon AMC is asking for valuations steeper than a bunch of NBFCs. That is one. Its own ROE at 21% is substantially lower than the other two leaders, which is ICICI and HDFC. And that would be something that would concern people, if not for subscription right now, and if not for making investment gains right now, then when the others come into fray, would there be a switch? I think that's something that a lot of people have said, that because it's the first AMC, it'll have that scarcity premium, go out and subscribe, yes, but at some point of time, when the other AMCs come in and if they don't demand sky-high valuations, there could be switches, because this one on certain ratios is much, much lower. Even the equity AUM, which gives the biggest bang for the buck for an AMC. So the CAGR growth for Reliance has been 33%. You would think that that's not a bad number. Look at what a Birla or an ICICI have done. 63%, 60% equity AUM CAGR in the last 3 years, which has undoubtedly been the best in the last decade of sorts for equities. So there are some concerns there. But if I just look at pure valuations, 4.2 times percentage, 4.2% of AUM is substantially expensive than global peers. But hey, India is growing more. So therefore, maybe people will say, go out and subscribe. And that's the conversation that I had with a lot of investors, and not just in India, a couple of investors sitting out of Dubai who have been friends as well. And all of them said that we know it's expensive, but there's a scarcity premium. We are going to subscribe to it because we know we'll make listing gains, at least, if not more.
And even the insurance IPOs, I think Sanjay Nair was here, he was saying that the insurance IPOs have been priced higher than the global valuation benchmarks.
So, you guys,
I don't know how you can. Well, yeah, I suppose
multiple ways.
Demand supply matters in this market, so scarcity will maybe help compensate for what some people might call valuations on the higher end.
But even that's debatable, right? So while they are at the higher end, and you are still getting it at valuations cheaper than what the promoter put in money in the previous 2 rounds. That is one. And if you just look at the anticipated, again, this is all forecast, but the growth that the company will do, forget the percentage of AUM argument and just look at what the company's done on revenues and profit growth for the last 4 or 5 years. Its profitability is great, unmatched within the top 5, quite frankly. And the expectation is that all of these guys will continue to grow at that 15, 20 odd % for the next 3, 4, 5 years. So then you at least have
I get
growth.
the broad story. I'm not suggesting that the broad story is not likely to play out.
So it's got growth. It's charging a premium for the scarcity. The question is, what when the others come in?
It's the best. It's the best asset in the Anil Ambani pack right now, right? Isn't it? I mean, by a stretch. Our defense we have little visibility on at this point in time. So, by far the best asset. So he's literally putting up a crown jewel, for public offerings, so to speak.
Yeah.
Okay. We'll see how this one goes. Yeah, it opens tomorrow.
Yes. So do watch out for that. It's a big day tomorrow, of course. But that's all that we have on First Word, at least. But do stay tuned to Bloomberg Quint, because we'll discuss a bunch of these possible triggers with Pradeep Shah of India Fund Advisors. And we'll talk in terms of corporate action now that the monsoons are over. Is construction demand making a comeback? Is retail demand making a comeback in the construction space? We asked that to Siddharth Mundra of Shankara Building Products. We decode Havells India earnings with Chairman Anil Rai Gupta as well. So all of those conversations coming up a bit later on in the show.
Yeah. Not to forget a cabinet meeting that happens at 10 o'clock today.
So, okay.
All right.
So a lot of important things to watch out for. But for now, for the next 1 hour, full tilt towards the day's trade. First, move on to Agam Vakil, yet again, who's standing by with the FNS setup for the morning. Agam, good morning, yet again.
Good morning, Neeraj. Well, we are heading into expiry, so naturally we will start seeing a lot of unwinding when it comes to the October futures. That's exactly what's turning out in the Nifty and its futures as well. 6.5% decline in OI. It's the same case for the Bank Nifty too. In fact, this time it's a decline of as much as nearly 15% in terms of unwinding in open interest for the Bank Nifty futures. The India Volatility Index has come off to a certain extent yesterday, but it is still above the mark of 12. That is crucial for a lot of analysts who keep an eye on this particular variable. Moving in, we really haven't seen too much of change when it comes to the Nifty put call ratio. That is considering the Nifty is more or less where it was in the session before. So Nifty push call ratio standing at around 1.53. The Nifty rollovers currently standing at around 17% is a little lower than the previous 3-month average of 20%. So this is where some of these traders are showing some skepticism. But of course, do remember, this can drastically change in the next 2 or 3 days, as it usually comes to be. But in terms of yesterday's trade, there's one option that stands out, and that's the 10,100 put, which has seen substantial amount of writing. On the other hand, a lot of unwinding in the 10,100 and the 10,200 calls. But moving in, two stocks I'm keeping an eye on when it comes to today's day of trade. PFC has seen an addition of nearly 3% in open interest. Fresh longs there. And of course, for VGuard, an unusual one showing up today. Another 8.5% increase in open interest of fresh longs there as well. But all eyes will be on the earnings and what they do for the Nifty as we move into today's day of trade.
Okay, many thanks for that, Agam. Let's pose that question to Abhijit Pathak, Director at Definite Solutions. He joins us on the show. Abhijit, I must credit you. Yesterday, when things were looking slightly iffy, you did mention that there is no reason to be bearish unless we move up. We moved up ever so slightly. We'll start off on a flattish note today. What should an average day trader do this morning?
Again, Nifty is range bound between 10,100, 120 to 10,200, 220 in this 100-point range. And that is mainly because of the call writing at 10,200 and the put writing at 10,100. So it will remain in this range for, I think, at least half of today. So any rise towards the resistance should be used to go short, or any dip towards the support should be used to square off and go long. I think you have to just play this range for, most probably I think this range might get resolved later today or tomorrow, because a lot of results are coming out.
That's true. Abhijit, one thing that I did notice yesterday in the dying moments of trade was, or rather the last 1 hour of trade, was the Bank Nifty moving up. Is there a trade there, either on the option side or on the plain vanilla futures side?
It's getting too close to expiry, but I would like to suggest going long in the Bank Nifty for November, maybe in terms of a call option of maybe 24,500 when it dips near 24,000 or 23,950. And I think Bank Nifty might go up from here, at least for the first 1 week or so in November.
Okay. So that's essentially the index strategies that you have. You likely believe it will be range bound. You'll recommend it at 10,200 call on dips. Any specific stock that stands out for you that people could trade?
For today, it's a bit dicey because, I mean, HDFC Bank is a good stock to trade, but it has results today, and 1830 on the lower side and 1865 on the high side, this range. So one can go long again near the support and see if it breaks out. If it breaks out above 1870, it can go towards 1900 also, HDFC Bank.
But a bit risky to play that. Abhijit, let's just revisit one of your earlier strategies before we thank you. What would you do with either a Sun TV or any of the earlier calls that have been given?
Yeah, Sun TV is still holding the stop loss which I gave out from 795, so that can still go towards 810, 815 today. So that will still be a buy with the same stop loss of 795.
But standard disclosures, Abhijit Pathak doesn't have a call for today. I mean, at least on specific stocks, it's the index that he's recommending and the call options out there, the 10,200 call option that you can buy in. Play safe with specific stocks, lots of results, so maybe might be prudent to sit on the sidelines if you're not an aggressive trader. Thanks a lot for that, Abhijit. Thanks for joining in today and giving us your thoughts as always. Okay, let's take a quick check at how the rest of the world is faring and give you sight of what the SGX Nifty is indicating as well. We'll start off marginally flat, actually flat. There's no marginal flat, but we'll start off flat in the session today, and the rest of the Asian markets have indicated that. The SGX Nifty indicating that 11-point downtick as well, but lots of stocks to watch out for. Let's get in Mayuresh Joshi. Needs no introduction, of course, but joins us right now on the show, fund manager at Angel Broking. Mayuresh, good morning, and thanks as always for joining in. It's an earnings-heavy week. It's an earnings-heavy day. Let's just first talk about a couple of earnings that came out yesterday. Par for the course, India Bulls Housing Finance. What would your verdict be? What should an average investor do?
Morning, Neeraj. So yes, again, I think the loan growth has been quite stellar for the company over the past few quarters, and looking at the kind of fall in cost of funds generally for the industry, I think a lot of players within this industry are probably going to benefit. The only issue that I probably see is that all these companies are chasing high quality retail credit, and that probably is a point of concern, because that is where the aggression in terms of offering lower rates and that probably emanating into lower yields for these companies might come through. So again, I think I'm very, very selective in this space. Yes, I think India Bulls Housing does offer a good dividend yield. I think the numbers have been exceptional so far. But on a bottom-up approach, on a price-to-book parameter, I think GIC Housing on declines is something that I'll continue to prefer.
Okay. Mayuresh, a couple of smaller names that came out with numbers, so I'm not getting into those, the likes of Oriental Hotels, but that one pocket, or rather two mid-cap pockets which did very well, and I want to talk about those for sure. One of them is steel, and there are news reports there, right? Bhushan Steel, circled by a lot of people, SR Steel and that whole resolution process. One of the newspapers is reporting that Electro Steel and Shrey Infra, or one of the entities of the Shrey Group, has made a bid for that one too. It's gotten this whole distressed steel space, if I can use that term, pretty excited. Would you dabble out there in that pocket, or if not within the distressed pocket, then otherwise in the normal steel pocket at all?
So there is always an opportunity, Neeraj, in all these cases, and what probably happens in a few of the cases that you mentioned, that few of the assets are operational and quite well managed. So I think if a good company does grab these assets at a good valuation, there is every scope for operational efficiencies to build in. But for the industry as a whole, again, I think if you bifurcate between both the products, the flat and the long end of the business, the flat products have probably shown a larger increase. The long product business, in terms of realizations, at least in Indian terms, is around 31,500 odd rupees per ton, which is sequentially lower, 1.5% lower, while the flat products are probably higher, or 5 to 6%. Having said that, again, I think the input costs, there is going to be a marginal benefit coming through, because coking costs have been lower for this quarter. But a large element also remains the Chinese factor. I think the Chinese factor in terms of restocking the Chinese New Year. I think at least for the next few months, steel prices, the LME prices are going to be on the higher side, and that will probably reflect positively on the earnings along with the low base. So again, I think being very, very selective, but yes, I think the hold rating on stocks like JSW Steel, Tata Steel do continue at our end, because I think the party might still continue for the next 2 to 3 months for these counters.
Okay, we got a bunch of queries that has come in on our social media page as well. I know Rahul Navandar is asking about the road sector and the Bharat 22 ETF. We'll talk to Mayuresh Joshi about those pockets as well. But for now, it's that time of the show wherein we talk about all the key newsmakers that our research team is wanting to point out. A bunch of result previews. We've discussed HDFC Bank as well as Infosys, but there are some others that will come out during market hours, so talk about those. And of course, also talk about the key newsmakers in the session today. So Yatin, Darshan as well as Nikki join in to speak about those. Let's first discuss the stocks in news. Darshan, let's start off with you.
See, some of the numbers that came out after market hours. India Bulls Housing Finance was a really strong set of numbers. NII was up almost 27%, profit was up almost 26%. Asset quality was rather stable, and a couple of brokerages have upped the target price for Indiabulls Housing Finance, so that will be in focus. Oriental Hotels came out with a strong set of numbers, 9% top line growth, EBITDA growth of 44%, margins at 15% versus 11%, and from a loss of 1.5 crores, it's turned into a profit of 3 crores this time around. And Automotive Stamping's weak set of numbers, revenues down almost 12%, negative EBITDA margin, and loss widens from 4 crores to almost 14 crores. What will be interesting is, Suntec Realty, Fidel yesterday was up almost 20% in the bulk deals that came yesterday. Fidelity has bought in 30 lakh shares or close to 2.4% stake in the company. So it will be interesting. S Chand HDFC Mutual Fund buys in 1% stake in the company. And PG Electroplast in the consumer durable space, Singapore-based HNI Satpal Khattar buys in close to 1% stake in the company. In terms of what's come in some of the newspaper reports, Anil Agarwal has told the government to privatize idle assets of Coal India and ONGC, and Canara Bank has hired iBankers for the sale of non-core assets. That is what the Mint has reported.
Okay. Interesting. Oriental Hotels. After a while, we're seeing hotel companies, or at least one small hotel company, do well. Let's see if that's true for the space. Remember, yesterday, Indian Hotels and a few other stocks were very active. But two stocks that could be active today and will come out during market as, at least Asian Paints would come out during market as, Yatin.
So Neeraj, if you look at Asian Paints, this time it should be a better quarter. Last quarter we saw some impact of GST. This time probably we could see some better volume growth. Of course, high single digits. If you look at the revenues, the Bloomberg poll is showing up a 13.5% growth on the revenue side, which is close to 4,270 crores odd. EBITDA also seen up close to 10%. Of course, the sales growth will be higher than the EBITDA growth, largely to do with the fact that we are looking at margins which are expected to be slightly lower on a year-on-year basis at 18.3%. That will be a dip of nearly half a percentage points. Of course, we have seen the crude prices fluctuate in the second quarter, and probably because of which Asian Paints margin could be under pressure. Profit seen up 4% at 514 crores. If you look at the key factors to watch out for, a volume growth of 6 to 7% is expected by the markets. Of course, this time the effective tax rate could increase from 31.5% to 32 or 33%, because of which profitability could be under pressure. But of course, as I was mentioning, the volume growth and the margin picture is something important that we'll be watching out for Asian Paints consolidated earnings.
Okay, so do watch out for those numbers, and I would reckon do watch out for the volume growth numbers at Ambuja as well, Nikki.
Yeah, you just got it right. I think volume growth and top line growth is what cement companies have been delivering, at least ACC and Ultratech Cement for that matter. The same trend is expected out of Ambuja Cement. However, we are expecting some sort of decline coming on the bottom line front, Neeraj. Also, the margins are expected to be stable for this company. Just to quickly run you through the financials, net sales is expected to rise as much as 14% year on year to 2,280 crore in this quarter. EBITDA is expected to grow as much as 20%. Margins pretty much stable, and we are expecting a decline coming in the PAT by as much as 13% for this quarter. Now, high prices in Western region are expected to aid the top line growth of the company. This, combined with the realization, is also expected to percolate down well in terms of the operating performance of the company. Volumes are expected to grow 10% year on year, but we are expected to see a dip of nearly 17% on sequential basis. However, we are expecting some kind of decline coming in from other income, which will in turn be seen, will have a bearing on the bottom line growth of the company. Key things that we'd like to keep an eye out on, first will be the freight and the power cost, which has been rising across the board for all these cement companies now. Volume growth, pricing and demand scenario.
Okay, we'll watch out for all of these. Some mid caps that have come out with numbers as well. Thanks a lot, Darshan, Yatin, as well as Nikki, for joining in and giving us that perspective. Mayuresh, you would look at the hotel plays at all? I mean, Oriental is but an iffy example to take, but Indian Hotels was pretty excited. And this quarter, the October, November, December quarter, could well be an interesting one in terms of occupancy rates as well.
It's typically, again, Neeraj, I think it's a strong quarter for the industry as a whole. But largely, again, I think if you look at the occupancy rates, you look at the average room rentals, and if you look at an enterprise value per key, I think it's still going to be very, very sticky. Selectively, I think within this spaces, I think a few companies might perform well. But generally, I think for cash flows to show a very consistent trend, I think hotel industry is still showing lumpy signs. So I think I'll be very, very selective. But again, I think I'll basically watch out for numbers, probably analyze them, understand what the management is talking about in terms of the demand outlook over the next few quarters. And it's entirely a scenario of a few quarters where demand goes up and a few quarters where demand goes down. So cash flows remain lumpy. So I think one really needs to understand the management perspective and the cash flows and the leverage on their balance sheet on efficiently managing their books and therefore generating earnings for investors.
Mayuresh, there is a pocket that has been very, very active the last few days, the last few months, if you will, and that's mid-sized real estate companies. It's a hated sector. People watch it with a lot of suspicion. Not too many people invest, but clearly there are takers because the stocks have moved up. Even a Godrej Properties, yes, but Oberoi Realty, Suntec Realty the last few days has been active. Colgate Paltil has given some 70-80% returns in the last 3 odd months, if I'm not wrong. So it's been quite spectacular, the moves that we've seen in some of these names. What are you doing? I mean, in your portfolios as well, are you selectively taking exposure to mid-sized real estate?
No, so again, what has happened, Neeraj, over the past few quarters, the entire exercise of demonetization, then you had the implementation of RERA and then again GST. Again, this has clearly caused a lot of pain in terms of a lot of developers, not specifically in the listed space, but again, a lot of buyers probably waiting on the sidelines, probably expecting good prices to come through. But again, as I've always been saying, at least from a real estate listed space, you probably need to divide the country into 4 halves. So if you look at northern India, I think clearly the supply is very, very high compared to what demand is. And these dynamics are not going to change. So you're probably going to see a scenario where inventory levels are high, the debt and the leverage on the balance sheets is high. So that probably is going to eat into a lot of your profitability in the bottom line for these companies. So I think I'll stay away from companies that probably operate out of the north. For companies operating out of the west, I think selectively there is some amount of marginal scope of improvement because demand always remains strong in these pockets. But again, I think you have to be really, really selective in the spaces that you're looking at. So for an area like Mumbai, I think you're probably looking at what kind of new plan the government probably brings and what kind of an FSI change does the developer actually benefit from. So again, I think remaining selective on that space within the western pocket. For the southern part of the country, you're probably looking at more to do with IT demand because a lot of the real estate demand is driven by the IT industry. We're probably seeing some signs of stickiness happening there. And again, inventory levels in selective pockets there remain extremely high. But again, I think most of the factors for these real estate companies is a reasonable amount of land bank. Yes, there is unsold inventory onto their books. But as the demand gradually picks up because of consolidation, RERA, and again, I think because of whatever implementations the government has done, a lot of black money probably not sustaining in the system, specifically in the real estate space, you're probably going to see demand come back gradually. So I think, yes, as a pocket, we remain selective. Brigade Enterprises is something that I like. The hospitality segment has been doing well for them. They've got large land parcels. As their revenue recognition thresholds start getting hit over the next few quarters, you're going to see a bunch up of revenue actually start emanating on their balance sheet. So Brigade is something that I'll continue to prefer from the mid-cap real estate space. I did like Colgate, but it has moved up significantly. So I think one really needs to wait for declines onto this counter as well.
Okay, do watch out for companies like Godrej Properties, wherein the model is something that is looking dramatically different from what it used to. Godrej Properties in particular, they are not really going out and buying land parcels anymore. The last few deals that they have done, it's essentially been a deal wherein they do the construction, the land belongs to somebody else, and they charge a premium and a maintenance fee for that whole construction bit as well. They multiply it into the area. So I think it's a very different and a niche business model that they're trying to create. Could be a very interesting play as well. Don't know about the valuations, but I think Mayuresh has given his verdict. If you indeed want to invest into afresh into real estate, Mayuresh Joshi believes that Brigade Enterprises could be the stock that you could watch out for. That is something that at least they liked. But it's 8:45 or maybe slightly over that time of the show for him to get you a full sense of the technicals as well. And Jay Thakkar as well as Chandan Taparia joined in to talk about the technicals and the derivative positions. Jay, I'll start with you first. A quick assessment of whether there is an index trade. Would you buy the Nifty or the Bank Nifty today?
Hi, good morning, Neeraj. Absolutely, I believe that, we are already long on Nifty, and we would also recommend, if at all there is any dip, then should be utilized as a buying opportunity only. Now, index has been forming good high tops and high bottom on the daily charts, Neeraj, after completing the expanded pattern at 9,700, and post that we have seen continuously Nifty, inching towards the higher end only. We had a target of 10,220, which was well discussed on your channel as well, and I think That has gotten achieved, and after that the target has been revised to 10,300 and 10,400 thereafter. On the lower side, now the previous low, the swing low, is pegged at 9950 levels. So from the point of view of that, till those lows are not broken, the uptrend really remains intact. However, for the conservative traders, I would say risk-averse traders, the near-term support is pegged at somewhere around 10,100. So with that as the stop loss on a closing basis, one can eye at around 10,300 at least till the expiry time.
Chandan, you play the expiry very well. What would your call be until the expiry? Would you trade either the Nifty or the Bank Nifty? What are the levels to watch out for?
Yes, in the entire expiry, the Nifty is up by around 4%. We have seen the strong recovery from lower levels by forming the support near to 96.85 just a couple of weeks back. And especially from last 6 to 7 trading session, the market has been moving in between 10,120 to 10,250 kind of level. The fresh put writing is happening at 10,000 and 10,100 strike, which indicates that now 10,120, 10,080 zone is likely to act as a support. But on immediate basis, we are witnessing some call writing at 10,250 strike. So that is likely to act as a hurdle. So as per the option data suggests, we are expecting the market to be in a range between 10,120 to 10,250 kind of level. But sustained put writing would restrict its downside, and as the market is trading higher above its volume weighted average, so any decline would be the buying opportunity. So we are expecting a up move towards 10,250 till it holds about 10,120 zone.
Okay, your two auto calls, Chandan, Maruti and Bharat Forge. Why are you trading these?
It's we have seen buying interest in entire auto pack in last couple of weeks. Major trend is positive, and from last 3 days, these are consolidating. But we have seen positive price pattern in Maruti and Bharat Forge, and these are the outperformer counters in the entire auto and auto ancillary space. Especially talking about the Maruti stock has formed a positive price pattern and taken support at its horizontal trend line. We have seen some put writing at lower strike, and call unwinding was also seen at 7,900 and 8,000 strike, which indicates the stock has potential to move towards 8,000 kind of level on immediate basis. So that is the reason that I have selected to go long on Maruti by putting the stop loss near to 7,700 and expecting it to head towards 8,050 kind of level. Here traders can also go with bull call spread by buying 7,850 call and selling 8,000 call. Talking about the Bharat Forge, this is the outperformer counter. Major trend of the stock is positive, and recent consolidation is giving a fresh opportunity. It formed a morning star pattern on the daily chart and negated the negativity of last 3 to 4 trading session. It partially filled a positive gap which made in last week. So here also I'm recommending to go along with a stop loss of 630 for an up move towards 660, 665 levels.
Okay, Jay, very quickly, your calls. You have an auto stock in Motherson Sumi, but you also have a call on United Spirits. You've been talking about this for a while now.
Absolutely, Neeraj, I think that United Spirits definitely has provided a very classic breakout from an inverse head and shoulders pattern, and we're expecting that move to actually come till the time of expiry this Thursday. We believe that 2600 levels are quite likely, because we have seen an absolute reversal in its momentum indicators, both on the daily as well as the weekly charts, which is quite important and quite significant. Seems to have completed a good corrective pattern as well, that is a zigzag corrective pattern on the daily charts, and after having formed this kind of a bottom, this stock is quite likely to inch higher with this kind of a bullish reversal pattern, as well as breakout from a downward sloping trend line with a buy crossover in these indicators. I think 2450 on the lower side will act as a very crucial support, and on the upside 2600 would be the target. As far as Motherson Sumi is concerned, I think the stock has consolidated for a couple of trading sessions now after having provided a breakout above its previous swing high, and I would say that since it has taken off its previous swing high, the fresh leg on the upside has been confirmed, which does make this stock qualify to inch higher towards the levels of 370, 375. On the lower side, I believe that 350 is a very ideal support. So with that as a stop loss, I would say one can go long here as well.
Okay. Stay on, gentlemen. So much more to talk about. On to our special segment on the show, Bloomberg Edge, wherein Jayesh Khilani joins us daily with what the Bloomberg terminal is indicating about a particular stock. Today's indicators are suggesting something on Colgate. Jayesh, over to you.
Morning, Neeraj. So we are looking at a very popular technical analysis pattern, which is called as bullish engulfing, which has been formed on the chart of Colgate with yesterday's close. First, let's have a look at how the bullish engulfing actually works. There is a 2 candle pattern formation wherein a bearish candle has been followed by a bullish candle, which essentially means that a red candle has to be followed by a green candle on the chart. Now the second candle body has to be bigger than the body of the first candle. That's the other condition that needs to be met. And the longer the body of the recent candle, the more bullish it becomes. Now once all of these conditions are satisfied, you don't need to look any further. That is where your confirmation actually comes in. Now going to the chart of Colgate that we have, that's the last two candles that we have seen on the chart of Colgate. Now I'm referring to this red candle, which is the bearish candle, and the immediate next candle, you can see that the body, the green shaded portion, is bigger than the red portion which is preceding that. So that is actually called as the bullish engulfing which has been formed. Now why this is important is because in this entire 3-month chart that you see on the screen, look at this price band of 1040 to about 1060. There has been strong support that Colgate has taken in this price range, and previously when this particular pattern was formed in the month of August, we saw a 10% rally from that point onwards, and the stock actually rallied to more than 1150. So if a similar thing is to pan out, we can see a 5 to 10% up move coming in for Colgate.
Oh, that's such an interesting chart though. But look at those two candles on the screen that Jayesh pointed out, or two sets of candles. It had happened in the past and it's given a 10% rally. Could it happen again is the question. The Bloomberg terminal certainly is giving an indicator. Do watch out for trade patterns in Colgate in the session today. Jayesh, thanks so much for getting us. That's really interesting. We should revisit this sometime on Countdown or a few other shows as well to try and tell you how has Colgate reacted. But this is a very interesting chart on Colgate. The question remains though, Mayuresh, fundamentally, is there a case for going out and buying a Colgate? Technically, it certainly seems to be, at least the Bloomberg terminal certainly believes that there is an indicator which might suggest a bullish pattern. Fundamentally, is there merit?
So again, two sides of the story, Neeraj. I think the argument that always goes against Colgate is valuations, and valuations again have been always on the higher side for this stock, for the exceptional return ratios that these companies has been able to deliver. So ROEs, ROCEs have always been on the higher side, and it's always expected to remain that way. You can probably talk about competition and how Patanjali and other players are probably eating into this space, but so far it has maintained its market leadership position both in the toothpastes as well as the toothbrush segment. Again, the variants that it is probably going to bring out in terms of the Ayurvedic toothpastes is a competitive shift towards Patanjali as well. So in that sense, again, I think you're probably going to see volume growth continue. The kind of moat that Colgate has developed around its products, the kind of brand recall that it has got, and the strong balance sheet that it possesses, my own sense is that a very stable kind of a top line and earnings growth is expected from Colgate over the next few quarters and years to come. So I think it does make a compelling case for investors to probably stay on if they're holding on to the stock, and probably accumulate this stock on declines in a staggered way if you probably don't hold this stock. So largely, again, I think it's a long drawn out story, but yes, I think if you're looking at returns of 10 to 12% on a compounded basis over the next 3 to 5 years, I think this is one stock that will not disappoint you.
Okay. Mayuresh, in terms of recommendations, what is it that you are telling people to buy into? I know you kind of briefly discussed a Brigade, but that's not your top idea. I mean, if somebody were to invest fresh money right now, where can they invest in?
So again, selectively we remain very, very positive, Neeraj, on the banking space. So apart from the larger banks within the mid-cap universe, Karur Vysya Bank is something that I still continue to prefer. Numbers were a little bit sticky in the quarter gone by. They're still expected to remain a little bit soft in this quarter and the next. But if you really look at the expectations of credit growth picking up for the industry as a whole, Karur might be able to report loan growth to the tune of 11 to 12% and that will probably assist in a bit in helping it maintain its NIMs around 3.6, 3.7%. Asset quality, as I said, was a little bit soft. It is expected to remain soft, but there are significant signs of improvement because a large part of recognition has probably happened over the last few quarters. So that gives some amount of comfort in terms of stability on the asset quality front. As far as ROEs and ROAs are concerned, we do expect them to inch up gradually over the next few quarters. And on a price to adjusted book, it still trades around 1.3, 1.4 times, which we feel is very, very reasonable. So yes, I think this on declines remains one of our preferred picks. From the larger space, my own sense is stocks like GIC Housing, which I did briefly mention, can probably do well within the housing finance space. India Bulls Finance, as I said, housing finance, as I said, has done exceptionally well, expected to do so. So I think a hold rating continues on that one. But GIC is where our expectations is a very strong loan growth to the tune of 25% over the next 2 to 3 years is not ruled out. Yes, there have been asset quality pressures onto their balance sheet, with GNPAs at 2.3%. But the management is very, very conscious and is going to resolve the asset quality issues. As far as the price to book comparison is concerned, compared to other housing finance players, I think this looks attractively placed as well. So I think this remains an interesting choice. And out of the larger universe again, I think Navkar Corporation is still something that I'll continue to prefer. Valuation wise, extremely cheap. The stock has not performed because numbers are not probably coming. And as I've time and again said as well, I think in the next 2 quarters you will still see some amount of stickiness happening. But the next few quarters will be very, very interesting for this company with the new CFS, the ICD with rail connectivity, the catering to South Gujarat volumes will reflect in earnings and bottom line growth to the tune of 30-35%. And again, I think that will reflect very, very positively on its bottom line. And again, I think valuation wise, as I said, is extremely, extremely cheap at this point of time.
Okay, stay on, Marish. Much more to talk about. Jeman, stay on. Chandan as well as Jay. The market's about, the pre-open, it's about to kickstart. 18 seconds. Remember, the rest of the Asian markets have shown their hand. We'll start off on a flattish note. For viewers who are tuning in right now, we'll have a flattish start. The SGX Nifty shown that. But it'll be interesting to see what the telcos and private banks have to do. Yesterday, there was a tug of war between the private banking space, with Axis losing out versus ICICI and HDFC gaining. Let's see if that continues today. This is what the first rates on the pre-open session are, and the Nifty is just so volatile. The Sensex too showing a 140-point uptick. I don't quite think that will happen. India Bulls Housing Finance is the one that came out with the results post-market hours. Inline set of numbers. Don't think there'll be a major reaction, but that's the one to watch out for. For now, yeah, again, all over the place. So give those rates a bit of a skip. Let's see what Reliance, Bharti Airtel, and Idea are up to after the big up move in trade yesterday. Can they continue the momentum? You probably not expect Bharti to do another 5%. If the pre-open rates are to be believed, they'll probably do 4%. But yeah, let's wait and watch if indeed Idea tops the 100 mark and Bharti Airtel continues to rise and shine. The big boy, HDFC Bank, participated yesterday. Let's see if that continues to do so ahead of its results today. Expect a steady state numbers, but let's see if that indeed happens. And among stocks that lost out in trade yesterday, I think one, Axis Bank, which was down and out in the session today, should be interesting to see if that has a semblance of some sanity. And Bajaj Finance, the last few days, has corrected quite viciously. Let's see if that sees some bit of buying at the lower levels. Nevertheless, that's the set of stocks. A bunch of mid caps and small caps, automotive stampings, Oriental Hotels, and a couple of others. I think the smaller steel stocks, we'll watch out for all of these. But for now, maybe just wait for these rates to stabilize. The currency is open, 64.96 versus 65.02. So fairly flat for the rupee as well in the session today. But what our brokerage is saying, we've kind of told you all the calls that have come in on India Bulls Housing Finance and a couple of other names. But let's take a look at the big brokerage calls for the day. Somit Sarkar is joining in for that. Somit, good morning.
So on brokerage today we have is Macquarie initiating coverage on Indian pharma sector. Now they're saying that the Indian pharma sector is expected to remain exposed to elevated US pricing pressure. Along with this, margin pressure will increase based on higher research and development space. Now this is one area when pharma companies have no choice and they'll have to step up their investment on research and development side. Also they're saying that developing complex generics and specialty products would be challenging due to the need of heavy investment and the lengthy and uncertain timelines for this. Based on this, they are skeptical on any upside coming in from the specialty drug segment for at least the next 18 to 24 months. However, they are positive on the recovery of Indian sales growth. Now, they're saying that the Indian sales would recover at 10 to 13% year on year for the next two financial year, that is financial year 2019 and financial year 2020. Now they have an underperform rating on Sun Pharma and Cadila, and their top picks are Jubilant Life Science, Strides Sassoon and Glenmark. For Sun Pharma, they have an underperform rating with a target price of 440. For Cadila, they have underperform rating with a target price of 415. For Lupin, Dr. Reddy and Cipla, they have a neutral rating with target price of 1022 to 2500 and 632. For Glenmark Pharma, they have an outperform rating with a target price of 728. For Strides Sassoon, again an outperform rating with a target price of 1100. And for Jubilant Life Science, outperform rating with a target price of 900.
Okay, so those are a clutch of stocks to watch out for. Thanks a lot for that, Somit. So, well, a lot of names. A bit later on in the show, remember, we'll also get in Pradeep P. Shah of India Advisors and talk to him about the macros and what stocks or what themes to bet on. But I'm just looking at what the Macquarie said in its report, and they clearly seem to be bullish on pharma. I think they while they're cautious as the stance, they're giving out calls on a bunch of these individual pharma names. And remember, pharma stocks have had a bit of an uptick in the last couple of series at least. Chandan, actually come in on that, or Jay maybe come in on that, either of you. Pharma stocks, they've had a bit of an uptick. Should an average trader book profits if he's playing series to series? Jay, the question is for you.
Well, I think, Neeraj, that, there is still some more room left on the upside. I think it's quite stock specific, I would say. If it is about Aurobindo Pharma, then I'm quite bullish on that. I think we can still see some more up move there. I believe that 805 to 810, that's the level to watch out for. One can book out profit around those levels. We've seen good amount of consolidation happening in this stock, and at the lower levels, we have seen this stock taking good support around the levels of 700 to 720. So I believe that Aurobindo Pharma looks quite good from the point of view of this series, next series, or even from the point of view of, I would say, Neeraj, the medium to long-term point of view, because this is one stock which I believe among the entire pharma pack is quite likely to make a new high going forward. Another stock would be Torrent Pharma. This stock recently has seen a good up move, a good breakout above the levels of 1350, and I believe that this stock is quite likely to head towards the levels of around, say, 1450 to 1500 zones, at least till this expiry. And I think on the lower side, this stock now has a good support around 1350, which was the breakout level initially, and then below that 1320. So these are the two stocks to keep on radar, and I think they're quite likely to perform. Other stocks too may see some good bounce back, but then I would say that they have a lot of resistance at high levels as well. So to trade those stocks at least till the expiry would be quite difficult, according to me. But these are the two stocks which are absolutely bullish and have given a clear breakout.
Quite frankly, one of the best performing stocks in the last 1 month in the pharma space or otherwise has been Natco Pharma. It's event specific. There has been news triggers which are driving that. But Natco Pharma has done reasonably okay in today's session. Slightly flat. I want to see what Oriental Hotels is up to. I want to see what Automotive Stampings is up to. And I want to see what some of the mid-cap steel names are doing. Let's just get those rates up. The pre-open rates, 6 minutes, about a couple of minutes, they'll settle down. Automotive Stampings, not a best of quarters. It's not a very well-traded stock, yes, but down about 2%. Oriental Hotels, wow, that's now at 40. It's up 7% in the session. It's good going. I think the numbers were very, very good. So good going there. Electro Steel, Bhushan Steel, Uttam Galva, that small cap, mid cap, distressed steel pack could be very interesting as well. In Electro Steel, of course, there's news bits today about Shrey submitting some bids. So that has got some positive triggers of its own as well. Let's wait and watch if indeed that reacts. Indiabulls Housing is the other one I just want to quickly mark. Should be flattish, about a percent and a quarter higher. For the benefit of viewers who are tuning in right now, Mayuresh, just a quick thought. If you were to look at an HFC, which one would that be? Would it be Indiabulls Housing or would you look at something else?
No, as I said, Neeraj, I think Indiabulls Housing has never disappointed, and the kind of growth patterns that it has exhibited, I think it is still expected to continue because the capital adequacy also remains extremely strong. The only argument that goes against is the valuations, but again, very high dividend yield counter. So hold recommendation continues. From a bottom-up approach, as I said, any decline onto a counter like GIC Housing, where the loan book is expected to double to 16,000 crore, the loan book is expected to grow at 25%, and where asset quality issues which have been plaguing their balance sheet compared to the others, largely expected to peak out. I think that will probably bring about improvement in NIMs and more sustainability and lowering of credit costs. So on a price to adjusted book, it looks attractive. So any decline on GIC becomes a clear buying opportunity. while Indiabulls Housing remains a clear hold from our side.
Okay, there's some questions, as we said, that have come on our social pages as well. I want to mark maybe a couple and try and see if we can get them answered. Any news or any investments in the road sector? Mayuresh, you want to take a quick dab at that? The road construction companies, anything that you are recommending?
Yeah, so it looks very, very interesting. So within the EPC players, KNR Construction is still something that I'll continue to prefer. Very strong order book. They've recently won an order with a JV to a tune of 884 odd crores. ROEs remain extremely strong, debt equity almost 0.10. So I think very strong balance sheet for a road EPC player. So I think KNR Construction remains one of my preferred picks. And within the typical road developers, I think Sadbhav Engineering on declines looks very, very interesting. The kind of IRRs that they've reported specifically from their road assets are looking very, very interesting. The kind of bids that the government is calling out for specifically on the HAM side, I think is going to ensure that the IRRs for these companies are maintained. And they've got a significant order book on the irrigation side as well, where the government initiatives will be even stronger going forward. So I think a large chunk of those orders can also be expected to come through with good execution. My own sense is that the cash conversion cycle will be far better over the next 2 years. So Sadbhav Engineering will also remain one of my better preferred choices.
Okay, Chandan, one more stock recommendation from your end, non-auto as well, because you've discussed the auto recommendations with us. There's a third stock that you're recommending, which is IGL.
Yes, we have seen buying interest in most of the gas companies, and these stocks are doing well, making higher tops, higher bottom formation, trading near to their recent lifetime high territory. We have seen buying interest in Petronet, IGL, MGL, all these stocks are really doing well, and especially IGL has seen built up a significant long position in last 4 to 5 trading season. It has seen open interest addition by more than 17 to 18%. So expecting this momentum to continue, even after the momentum of 4 to 5%, I am expecting this rally to head to a 1650 to 1670 level. So recommending to buy even at current level or on a small decline with a stop loss of 1580 for an upside move 4 to 5% to us 1670 levels.
Okay. Gentlemen, just before we thank you, stay on, but it's 9:10, that time of the show, and we tell you all that you need to know with regards to trade so that you can be ahead in trade today. So in terms of results, Ambuja, Asian Paints, HDFC Bank, Infosys and Z Entertainment are the nifty companies that are going to report numbers today. That's about 17% of the nifty weightage. In earnings after market hours, Indiabulls Housing Finance and Oriental Hotels reported strong numbers, while automotive stampings reported a weak quarter. The stocks are reacting duly. Fidelity has picked up 2.4% stake in Suntech Realty, while HDFC Mutual Fund has bought a 0.9% stake in S. Chand. HNI Satpal Khattar has bought stake in PG Electroplast. Macquarie initiates coverage on the pharma sector, says top picks are Jubilant Life, Strides as well as Glenmark. 5 metal giants expressed interest in SR Steel. The bidders are ArcelorMittal, Sumitomo Corporation, Vedanta, Tata Steel and SAIL. This should keep the distressed steel space excited. And in terms of investors or who's meeting whom, our recent property, Endurance Technology is going to meet Nomura Asset Management today, while Bharat Forge is going to meet DSP BlackRock. So those are some interesting names to watch out for. Mayuresh, you've given us a bunch of ideas as well. Just a quick 30-second answer. What would you completely avoid at this time?
No, so a few players out of the capital goods space is something that still would not be on my radar. More to do with the investment cycle still not kicking off entirely. And again, I think the kind of orders that they have on their books, the execution patterns also look very sticky, which results in a large receivable book. So capital goods as a space, I think generally is something that I'll avoid, at least at this point of time.
Okay, Mayuresh, we'll leave it at that. Thanks so much for joining in today and giving us your thoughts. Always great having you. Okay, just about 2 more minutes left before the markets start. And before we get in the top trading ideas from both Chandan as well as Jay, just one quick word really on a stock that has been reasonably hot. We don't normally discuss it, but Adani Port, promoters have been buying from the open market almost every single time that the news comes in, the stock reacts, only to fall back a little bit. At 407, Chandan, what would you do with Adani Ports from an expiry perspective or from a medium-term perspective?
See, first thing, we don't have coverage on the counter, but looking at its price pattern in the moment, it seems that stock can start the next leg of rally. It is support near to 395 zone, and if this support is expected, it can even rally towards 425, 430. So overall price pattern looks quite interesting, and positive move is expected, but we don't have any recommendation coverage on the same.
Okay, fair call. So before we thank you, gentlemen, let's get in your top calls for the day. Jay Thakkar, if you had to bet on one stock for the morning, which one would that be?
I've already recommended two, Neeraj, but then if I have to add one more, then it would be on a buy on Container Corporation, which
Jay,
I have seen a good.
Jay, you can choose one top idea for the day today. It could well be a repeat idea, but one top idea for the day.
That is definitely going to be United Spirits.
Okay, it's a buy call on United Spirits. What are the targets, Jay?
2600 would be the target, and 2450 will be the stop loss.
Okay, so the top call from Jay Thakkar is United Spirits. 2600 is the target. Chandan, if you had to bet on one stock for the day, which one would that be?
I'll go with Maruti. Because of its price pattern, it has bottomed out after the correction of last couple of weeks. So expecting this stock to move on upside, looking for target towards 8050, one can place with a stop loss of 7700.
Is this a day trade, Chandan, or are you playing it for the expiry?
For just 2 to 3 days.
Okay, so from a 2 to 3 day perspective, Chandan Taparia's top call is 7865. We also have Mr. Pradeep Shah, but just before we go to him, Chandan, before we thank you, very quickly, 20 seconds, the levels that you're watching out for the expiry for either the Nifty or the Bank Nifty.
See, I'm expecting Nifty to settle about 10,178 kind of level, and expecting Bank Nifty to hold about 24,000, because Bank Nifty fell down by more than 800, 900 points, but maximum put OI is intact. So because of the put writing of 24,000, I am expecting some buying interest in Bank Nifty and Nifty both.
Okay, Jay, as well as Chandan. Gentlemen, thank you so much for taking the time out and joining us today. We'll be joined by Mr. Pradeep Shah. He's already joined us, of course, but we'll just do the market open first and then go across for his thoughts of Mr. Pradeep Shah of India Advisors. But 14 seconds left for the markets to start. We'll start off on a flattish note. Watch out for Indiabulls Housing Finance, though that showed some green in the pre-open rates. Let's see if that lasts in the market open as well. But I'm very, very interested in seeing if indeed the telcos can do some repeat of the performance that they have shown in the recent past. This is the start this Tuesday morning. 0.25% for the Nifty, 0.33% for the Sensex. Actually, it's very volatile. But the Nifty Bank, interestingly, after showing 0.33% gains in the last half an hour or 45 minutes of trade, up another 0.25%. So that is not buckling down, which is actually a pretty good sign. Bring up the heat map and see if indeed banks or what kind of banks are participating. This is critical to the index doing well. Firstly, a flavor, a lot of green, very little red, which is actually a pretty good sign. Now, what's moving around, I think we're having some gains to Indiabulls Housing Finance and Kotak Bank. And amongst heavyweights, I can probably see Reliance participating about 0.5% higher. But no big losers, that's the big thing. Bharti's got a bit of a pause today, but that's warranted as well. Bharti Infra down about 0.5%. But no big losers. I think we have a bunch of gainers, but no big losers, which is a good thing. Bharti Infratel, though, after losing out yesterday, is down another 2.5%. So this is seeing some return to gravity after having a stupendous run. Bring up Reliance Industries, was up about 0.5%. And let's see, actually it's a flattish day of trade for Reliance Industries as well. Indiabulls Housing Finance, I think, is the key one. That is the top performer on the index, up about 1.5% at 1356. It is packing quite a bit of a punch. Some mid caps and small caps could be active. I would look at an Oriental. I would look at what's happened to Indian hotels, what's happened, because that space seemed to be buzzing. Oriental Hotels on results is up about 8%. Indian Hotels was up and active yesterday, up another 0.5% today. So this pocket could be interesting. Let's see if indeed the other results turn out to be as good or no. And I would probably also look at companies like Automotive Stampings, a poor set of numbers. Let's see if that is reacting. The pre-open rates was indeed reacting, down about 6% in the session today. Lots more stocks to mark, but let's first get in an initial word from Mr. Pradeep Shah of India Advisors. He joins us right now on the show. Mr. Shah, good morning. Thanks so much for joining in. What are your thoughts? Does this look like a market which will reward investors if you have a medium to a long-term view? Or do you think that there is ample reason for some bit of a correction, either due to valuations or due to liquidity or due to a lot of issues hitting the market in the primary side, for the markets to correct that wee little bit?
Firstly, in every market in India and of course elsewhere in the world, selective buying, well-researched buying has always paid off. And I think even in this market, which is at its historic highs in terms of price earning multiples and so on, you still see pockets of outperformance possibilities in companies as their profits improve, as they come out with products or capacities or marketing business models which are different and better, and then they outperform their competitors. Having said that, there are lots of reasons for caution now, and we see that in the global press very clearly, a little bit in the Indian press. In India, just remember that in June, July, August, September, we've had 7,000, 12,000, 19,000 and 18,000 crore rupees flow into plain equity funds alone. In addition, there's money going into balanced funds, which are 65%, as you know, invested in equities. So a lot of money is flowing into equities. So there's a lot of pressure on these mutual fund managers to deploy that money. Some are taking cautious stands, holding back and buying when they see value, but others get carried away with momentum buying. That's why you see these big run-ups and this big volatility when there's marginal outperformance. Commodity businesses are doing extremely well, partly, of course, because the global cycle, US, UK, Europe and Japan are seeing an improvement in their economies. But the other signs of caution are pretty evident. You saw the Deutsche Bank report, which talks of several possible trigger points. The most important, I think, is this calibration of interest rate rises in the United States, accompanied by reduction in the Fed balance sheet size. That can pull a lot of money out, and if the calibration is not done right, you can see a lot of hiccups in the market, a big correction. And of course, if interest rates rise, the US dollar will strengthen. And one of the reasons why the US is doing well is that the dollar has fallen so badly. Then we've had the Chinese central bank governor, who's now leaving, but he blurted out the Minsky moment concept. He said there is a possibility of a Minsky moment, and this is where everyone gets worried that if China is talking of an asset price correction, a sudden correction from something latent and visible or hidden, we must sort of be cautious. So there are reasons to worry.
And are you worried then? My question to you simply would be, what kind of chips are you taking off the table? I mean, is it a percentage of your portfolio? Are you skimming profits where you've made? What is it that you're doing?
Absolutely. I think where you see multiples, I'm just giving example, Indraprastha Gas and so on, we've done extremely well, very good company, but you see it at multiples and prices which are going high, then you like to sort of think about taking off some money from those kinds of scripts where you've done extremely well. Your target price has been overshot substantially. So certainly that will continue. All the asset managers will be probably looking at their portfolio for trimming and cropping some of the gains and gathering them and recycling them, because irrational exuberance can continue for a long time. We saw it in several cycles in India and abroad, and so one cannot stay out of the market, because then there would be underperformance. So you have to be in the market, but you must from time to time crop gains when one sees that the target price have been met or gone beyond.
Okay, Mr. Shah, the other question is that while we may, and it remains a big question mark, but we may see some bit of outflows, and we're not immune to that. I mean, the last 2 months, if anything, we've seen enough and more FI outflows, but well compensated by the domestic liquidity, which seems to be here to stay. At least the SIP money seems to be here to stay, and that's about $1 billion coming in every month. Will that compensate, or do you presume that if indeed there is substantially more outflows, and what's the probability of that in the first place is what I want to ask you, but if there are some FI outflows meaningfully larger than what we've seen already, is there a case for a correction?
I don't think the correction will come only from outflows. The correction will come from mindset changes. If a global event takes place, a North Korea, US blow up, or something on interest rates, which is very unsettling. Or for instance, as Steve Mnuchin pointed out, in the United States, if the tax proposals do not go through or go below the expectations of the market and a dramatic drop takes place in Western markets. You remember 1987 when there was a 20% drop in values overnight with no major trigger, as it were. That kind of thing can unsettle markets globally, worldwide, including in India, because we are all interconnected at the end of the day. So that global event development is probably, in my mind, the highest risk. And then there can be political developments in India. We saw demonetization, how it suddenly and unexpectedly it struck the Indian markets. And then we've had GST, which was planned, but its implementation is causing some concern from time to time, and job losses and so on. So these kinds of triggers, if there is a political decision which affects markets dramatically, you can see a major change in sentiment, and then that sentiment gets translated into prices and so on.
Okay, Mr. Shah, this market is kind of bipolar, and let me define my question. And different people use bipolar in a different way. What I mean to say is that, one, we've got extreme preference for quality names, and therefore the multiples are substantially high out there. But there is also this other side which is starting to brew, wherein people are buying into fractured, not really broken, but fractured balance sheets or fractured business cycles which are trying to make a bit of a comeback. We've seen that happening in steel, we've seen that happening in real estate companies or housing companies as well. What do you think wins the battle over the course of the next 6 to 12 odd months? And where are you fishing, if at all you are fishing right now?
You hit the nail on the head. Some of these investments in some of these fractured companies which have potential for revival, but in different forms, just the assets may get transferred, not the company and so on. They seem to be, to me, far too speculative for an investment manager that's looking for value proposition, that is a principled approach to buying into equities. This is very iffy and event based, and so I would say that if the resolution of a company under the Insolvency Act comes out right for the existing shareholders, wonderful, the shareholders will do very well. But if the assets get sold and the company remains a shell and some buyer takes it over, I mean that may not really help existing investors. So it is too iffy to my mind, and the events have not played out as predictably as we would like to see, because the law is very new, the insolvency law. So there have been not many precedents as to say how the existing investors will fare out of it. So I would be very hesitant to buy. I would much rather go for the straight approach of buying value stake picks on the basis of good managements, their growth prospects of their companies, and based on products, markets, positioning, pricing, etc. And of course, there will be some exuberance in some of these sectors where we can predict that India's consumption demand will go up. So you see these consumer stocks doing so well. For outperformance, it may not be wise to buy at 50 multiples of earnings, and it may be better to go for the under-researched mid-cap stocks, and not necessarily only in the consumer space. There are so many other sectors. I mean, you see the power sector now, whether a power sector play has to be in the generation or the distribution, which are very capital intensive, or in some other component area. That is a call that the asset manager can take and search out stocks. There's in every area, there is that possibility to make money by identifying under-researched companies which are doing well, they're good business and robust business models and excellent managements.
So what would you be advising your fund management team to do? Let's take the example of power, since you mentioned it's a wide pocket, fractured balance sheets. Selectively, power distribution, etc. has done well, but the generation companies haven't, and maybe that's why they are available at the valuations that they are. Where can an average investor take exposure, if at all? What would you be advising your team to do?
So you've seen, I'm just giving examples, the KECs of the world and the Kalpatarus of the world, they supply power transmission towers, and of course there are component manufacturers, whether it's transformers and electricals and switch gears and so on, or meters and so on. As for instance, this solar or renewable energy push takes place, then there will be a change. You will need smart meters, you will need smart grids. Are there people who can supply those kinds of things? Is there then a value proposition though? That's the way I would look at that sector. It is not obvious to me that people will make money from generation businesses which are large, capital intensive. There's also the threat from these renewables which can be put up very quickly and in large capacity, and then the government's policy of allowing renewables to eat into the base load power stations markets. And we saw what happened in Germany, for instance. The RWEs and EONs suffered very badly as renewables took up 24% of the market, and renewables are not baseload stations. So this is something which one has to think of. Where will the money be made if regulations change, and especially in industries which are very heavily dependent on regulations? Look at pharma industry. Pharma, I mean, logic is the logical argument that demand will continue to grow is very sound. But then if regulations come in and put price controls and disclosure of costs and generic and then other elements such as those elimination of fixed dose combination and so on, you can disrupt the industry quite dramatically and disrupt value for shareholders quite dramatically. I think the government exported through its policies our whole API, the active pharmaceutical ingredient market, to China. Now, if you have to bring it back, you may have to relax on price control. You may have to make concessions. Now, does the government recognize this? And if it can make concession with one stroke of a pen, can it take away those concessions at another stroke of the pen? These are issues which will remain in that industry, for instance, for times to come. So one has to take a call how companies are addressing it. And you see Indian companies addressing it through export markets and diversified export markets and a range of therapeutic areas that they cover and so on. And some going also into OTC products which are not under price control. Whereas some of the multinationals are very, they go only for ethical products and research-based products and so on and so forth. And they can be hit by these regulatory changes much more.
Okay, Mr. Shah, final question really. You've seen multiple cycles. In the current cycle, which is that performing pocket which you reckon could continue doing that? I think the simple answer is NBFC, but within that, there are probably a bunch of pockets which are overvalued as well. But what do you think is here to stay and make money for investors over the course of the next maybe 4 or 5 years or more?
NBFC, yeah. So I think even in NBFCs, you have to be cautious and careful. All these proposals, there's a big fad going on that you can lend and small loans without unsecured on the basis of just data analytics and your money will come back. I think the cycle is not played out. So one has to be careful and cautious. We saw one hiccup once when the regulators struck in Andhra Pradesh and so on, and how companies got affected. But without even regulatory intervention, there can be just market-based risks in those companies. But generally, yes, the good banks can do very well, and we've seen the HDFC as a classic example of years of outperformance. And then we see consumer products companies, well-established brands, local names, as well as international multinational companies with their multinational portfolios, addressing consumer needs with the Indianized tastes or Indianized touches. Those will continue to do well. At what price to buy for outperformance? It's a different call. But certainly, those companies will do well, and their share prices will reflect that performance.
Okay. We'll leave it at that. Mr. Shah, thanks so much for taking the time out and joining us today. Look forward to have you more often on this forum.
Pleasure. No.
That's Mr. Pradeep P. Shah of India Advisors. Interesting thoughts there on a couple of pockets. Believes that there might not be too much money to be made necessarily by buying distressed assets, but power could be one interesting pocket wherein people can make money if they are looking for fishing into the distressed asset space. Do your research thoroughly though, is what he advises, as probably everybody else does too. I'm just looking at what is moving before we take that break. GVK Power continues to rise and shine. Speaking of troubled assets which are moving up, I think this one has been on a roll the last 6 or 7 odd sessions at least, if not more, wherein Equity Intelligence mentioned about them buying into the company over 6% stake. I think since that point, this one has been on a roll. 8K miles, interestingly, another 5% today after the 8% move that we had in trade yesterday. So a good move there for that too. Soba, the last couple of sessions has been doing well. So up another 5% in the session today. Bhushan Steel up another 8%. So good going for that one. And Moil, Sandur Manganese and Moil both had a fabulous day of trade yesterday. I think double-digit gains for both of them in trade yesterday. In today's session, Moil at least is up 3.5. Sandur Manganese should also come up on your screen. Another 3.5 for this one. That's a robust move that is coming in all of these. And last but not the least, want to mark Delta Corp. It was in a manner of speaking, a consensus recommendation on the channel. Ramesh Damani spoke about the gambling business as the big bet for the next couple of years, and maybe if not more. Ajay Srivastava, spoke about Delta Corp specifically on the Murat trading session as well. And this stock is touching new life highs for itself. 3.5% up, 245. It's had a fabulous run the last few days. The numbers weren't too bad either. Take a quick break. But up next, on the corporate corner, really, we speak about a bunch of things, including demand for construction retail, whether it's back after the monsoon. Siddharth Mundra of Shankara Building Products will talk about that. We'll decode Havells India earnings with Chairman Anil Rai Gupta.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Watch us live in conversation with Ramdev Agarwal on our next episode on the power of compounding.
The concept remains very simple. Businesses are compounding machines, so you need maths which matches with that. We will talk about the next level of compounding and how we work in actual life.
Watch us live with Ramdev Agarwal next Tuesday, 11 a.m. as we discuss the power of compounding in the process of investing. Send in your queries using the hashtag AskBQ to BloombergQuint.com. Write to us now. Use the word Ramdev in all your queries.
You're watching Indian Open. With the monsoon now almost over, construction activity should have finally picked up, and one firm that stands to gain from that is Shankara Building Products. Joining us now is the CEO of the company, Siddharth Mundra. Siddharth, good morning. Thank you for joining us here on Bloomberg Quint. Your company was to be one of the beneficiaries of the shift under DMON and GST to the formal sector. What has the last quarter been like for you? And I'm not asking for specific numbers, but if you could give us directional moves on how you've stood to benefit from this underlying shift in the economy?
Hi, good morning. I think the last quarter, there have been certain operational challenges, post the GST implementation. June and July effectively went in a lot of the transactional issues, a lot of confusion that prevailed in the market. And generally, Q2 is a soft quarter for us. Monsoons generally dampen overall home renovation and construction activity. So I think Q2 may not give us enough leads into how this is actually shaping up. But directionally, both these moves, demonetization and GST, should be very beneficial for organized players like us.
So how does that change your outlook on the ongoing quarter, which is the third quarter of the year, the quarter in which construction activity picks up and in which you probably stand to gain the most, both from the formalization move and from a good quarter?
So we continue to be positive actually in terms of our overall guidance also that we have given for this year of a robust retail revenue growth. So that we continue to keep be fairly positive for the overall year as well.
Okay. You are not inclined to revise your guidance upwards given the moves in your favor or in the favor of companies like yours?
I think it's still early days actually. I think let us deliver our performance.
Okay. Neeraj,
interesting. Yeah. Good morning. And I just wanted to know, I mean, it's documented within notes, but just a sense of how would the next 3 years look like for your various business segments? Because unless I'm very wrong, you are on record saying as well that you want to reduce the channel sales. They obviously, while constituted a large part of your business in the past, because of the EBITDA margin accretiveness, have lost favor to retail and enterprise. How would the structure shift from what it is right now over the course of the next 3 years? And what would that do to the operational metrics and the operational picture of Shankara?
Hi, good morning. And you're right. What we are trying to is essentially rejig the overall revenue contributions of the three segments that we have. Currently, retail contributes around 50% of the overall revenues. Then we have the enterprise business, which is around 30%, and we have the enterprise business, which is around 20%. What we intend to do over the next 3 to 5 years is to take the share of retail to almost 70%, the enterprise to stay at around the 20% levels. But the channel, we would like to take it to 10% or below. What it will do to our overall margins of the company will be, even if the individual margins continue to be the same, because the share of the higher margin retail will go up, this should increase the overall EBITDA margins of the company. The retail is also the more capital efficient part of the company as compared to the channel part of the business. So hopefully the balance sheet will also become much stronger with the share of retail going up.
No, that even I'm sure of, that your margins will look much better than what they are looking right now. The only question in the minds of people is, how better can this better be?
So the retail margins that we delivered last year was around 10% at the EBITDA level. We at a company level we delivered around 6.7% kind of an EBITDA margin. What we are aiming for is that for the next 3 years, these margins should possibly move up by say 50 to 100 pips. Just because of the shift of the revenue types.
Sorry, did I hear you say 300 bips?
No, 50 to 100 bips.
60 to 100 basis points.
No, 50 to 100. 50
okay.
to 100.
Oh, fair call. Okay, I was just really positively surprised if indeed the numbers could have been so large. So you're meaning 50 to 100 basis points, excuse me, over the course of the next 3 years. Fair call. The other bit that happens in case of successful IPOs is that the IPO is but a first stop of fundraising, and eventually within the next 1.5 to 2 odd years, companies come out and raise for the money, the higher stock price being the higher currency. For you, it's worked out very well. Would you envisage the need to raise funds over the course of the next 12 odd months?
it's a little premature because it's only 5 months back that we did our IPO. Having said that, there are a lot of opportunities that we keep seeing, which could be organic as well as inorganic. So while our organic plans are fairly funded, if there are inorganic opportunities that come our way, I think a fundraise might become an interesting option to fund those. But as of now, there's nothing that we're actively considering.
Would these inorganic plans be geography specific because you're very strong south? Would you feel the need, or do you already feel the need to expand your geographical presence within India to any other pocket which is not as dominant as south for you? I mean, west or north for that matter?
No, so our plans would largely continue to be in the south for the near term because we still feel there are a lot of white spaces in South India itself. There are certain geographies and certain product categories in which there are certain capabilities that we need to build out, and our overall efficiencies can be best leveraged if we are slightly more geographically focused at this point of time.
Okay.
So it will be largely south.
Okay. And save for the inorganic moves, you would probably do what, a 20% sales CAGR for the next 3 years, if not more?
So at the retail segment level, yes, but not possibly for the overall company.
What would those numbers be? Because when I speak to investors and their expectations from you as a consolidated entity are much higher than the numbers that you spoke about. What would be the consolidated CAGR growth numbers that you would conservatively estimate Shankara to do?
I think mid-teens is something that we should.
And this is purely organic. If you add indeed some inorganic measures, then those growth numbers would vary substantially, or would this be more a string of pearls kind of strategy that you would adopt?
Yeah, so as of now, this is all organic. So let's see what kind of inorganic things come.
Fair call. We'll leave it at that. Thanks so much for taking the time out and joining us today, and keep up the good work. And we'll talk to you post your quarterly numbers.
Certainly. Thank you so much.
That's Shankara Building Products. Boy, has it had a good ride post its listing. It listed strongly, but if you just look at the last 6 months, I mean, you'll have the 5.5 month data to be precise. But yeah, just look at the kind of gains that the stock has shown. It's almost been doubling from the listing price, not quite the issue price, I must add. It's had a really, really good move, Shankara Building, in the last 6 odd months. 100% gains.
All right, let's move on to the other big company. Havells India reported an operationally strong quarter with profit rising 17% to 171 crore rupees. But the biggest surprise was the margin numbers from the newly acquired business, that's Lloyd's Consumer. To discuss those numbers in detail, we've got with us Anil Rai Gupta, the Chairman and Managing Director at Havells India, and of course Agam Vakil standing by. He's the sector expert. Agam, let me hand it over to you.
Sure. Good morning, Mr. Gupta, and thanks for joining us. So, my first question will have to do with margins, which has been a bit of a surprise. How much would you attribute this expansion to commodity costs, and what are those commodities where this advantage is coming from?
I think there's nothing to be really excited about. Two important aspects in this. One is in our cables and wires business, there's a significant margin expansion, and that's also because of the fact that in an inflationary environment of copper, aluminum going up, we have significant stocks lying with us, and there is a one-time advantage which comes because of old prices stock. So this is one advantage. The other thing is that especially after a very bad first quarter because of the destocking which happened in the trade, we reined in our costs. We had a complete cost control in the second quarter, and a lot of it was taken off the advertising and promotions as well. So in the second quarter, we reduced this almost by 1.5%. So these two factors added to the margin expansion. I think going forward, we should be coming back to our general levels which we used to have before.
Mr. Gupta, you did speak about your cables business, and a good third of your revenues come from that segment. And while there has been an expansion in margins, growth is extremely slack. Do you expect this weakness to continue in the second half of this financial year as well?
I think, for the last few quarters, there has been sluggish demand in the construction industry, and cables and wires, and both switchgear and cables and wires go into that category. So we do expect that these businesses will have a muted growth in this quarter, in the coming quarters as well. Hopefully things will improve also because of the fact that in these product categories, the overall excise plus VAT put together was around 18%, which is now about 20%, which is the new GST rate is 28%. So there is a 10% increase in price for the consumer. So there is a little bit of inertia to get used to this kind of a hike in prices because of the new GST rates. We believe over a period of time either the consumer will get adjusted or the government may reduce the rates. So things will come back to more normalized levels in the future.
Mr. Gupta, research firm Channel Checks also say that non-billable transactions have reduced, and GST, of course, has also hastened this process. How does this shift focus between wholesales and distribution?
Well, there is mixed response on this. I think overall, we do expect that GST will bring in a very positive empowerment in billing sales, and unorganized sector will get hampered because of this. But it is not happening to the extent that we expected. And again, I attribute this to a very high GST rate, and also the fact that even today, some of the traders are not really scared of the fact that there will be high compliance expectation from the government for a few months. And they are resorting to the old practices of supplying goods to the consumer without bill and then finally adjusting it through selling it to some large institutional buyer. So this practice has started, and I hopefully with EVA bill coming in, with overall better compliance coming in, and maybe the tax structures also might get reduced over a period of time. So things should start improving from there.
Reports also suggest that most of Havells products have medium to low penetration, but this also means an improvement, substantial upside in growth. Based on that, in terms of strategy, what are the product ranges that you're focusing on that can take advantage of your improving penetration?
No, I believe most of our product categories have huge scope for penetration increase. Whether it is lighting, which goes through distribution, to small towns and rural network. Lloyd, for example, poses a huge opportunity for us for channel expansion. So there are many opportunities in every business category, and we definitely, with this new GST and better compliances, I think we'll be in a much better position to achieve this.
Also, when it comes to this quarter, the concerns were that your business, that is your Lloyd Electrics business, may go ahead and dilute margins. But from what I'm looking at, the current picture is that margins have been substantially higher than what the street was going with. Is this a one-off quarter, or can we expect the strength to continue as we move on to the next couple of quarters as well?
No, I think we've never expected that Lloyd would negatively, drive the Havells margins. The margin percentage will be lower in case of Lloyd. That is definitely there. Over a period of time, over a longer period of time, it will catch up to those levels. But today, we never expected that this will be at a low level. So we believe that these margins are sustainable.
And finally, Mr. Gupta, a word on your lightings and fixtures segment, which has done very well, which has also been relatively more consistent. If you can give us an outlook on that segment as well.
I think there are two factors. One, the government is really giving a lot of input to LED expansion. There is a lot of, not only the government, but the private sector, both are looking into replace the conventional lighting to LED lighting, because the paybacks are now very good. But also the other thing is that government also has taken a very proactive step of keeping the GST rates low in LED lighting. And this again comes back to my point that in case of electrical products, where it's not really a luxury products, there's sort of a need for every housing or even low-cost housing. If the rates are in the range of 12 to 18% GST, things would be much better. And that is the case with LED, and growth has been significant there. So I believe over a period of time, things will get adjusted. This is what we are getting the reports from the media.
Mr. Gupta, thank you for joining us and taking us through those numbers. With that, it's back to you, Neeraj.
Yep, thanks a lot for that, Agam. So, well, that's the interesting conversation with Havells. The stock really hasn't done too much. In fact, came off after the results that came out yesterday. The market was a touch disappointed and down another 4.5% today. Let's see, maybe it'll find some balance a bit later on. However, the markets by themselves doing reasonably okay, up about 1/3%, the Nifty Bank. I keep on repeating this, I sound like a broken record, but the Nifty Bank is up 0.6%, and that's the reason why the market is doing what it is doing. 8K miles, big mover. NCC 5.5%, and well, boy, HFCL makes a bit of a comeback, up 4.5%. But stock of the morning, clearly to my mind, is Delta Corp, up another 4.5%. But let's talk about Nifty earnings. There are 5 index companies coming out with numbers. We've chosen 3 out of the 5 to talk about right now. Our research team joins in full strength to talk about all of these. We're talking about Havells, a company that operates, well, maybe in a similar space, but consumption space essentially. And Yatin Johnson to talk about Asian Paints. Let's start off with that. Yatin, what to expect from this one?
Good morning, Neeraj. As far as Asian Paints is concerned, this time it will be a healthy quarter. Remember, there is the fear that GST might lead to some aberration in the results. And also we have the second quarter crude prices which remain firm, which doesn't augur well for a paint company like Asian Paints. So if you talk about the revenues, we are expecting a 13.5% growth on the top line. Revenue seen at close to 4,270 crores. As far as the EBITDA growth is concerned, that will be slightly low because of margin pressure. So we are expecting 10% EBITDA growth. EBITDA seen at close to 780 crores. As far as profits are concerned, analysts are expecting this time the tax rate could be as high as 33.5%, because of which the overall profit number could be lower. So we are expecting a profit growth of only 4%, profit seen at 514 crores. As far as the important factor, which is the volume growth, the street is expecting a probable, restocking in the paints business, and hence the volume growth is seen at close to 5 to 6%, which is basically a single-digit volume growth. Of course, the management commentary for the coming quarter, second half, is something important that we'll be watching out for. But on an overall basis, if you look at the top line, double-digit growth, of course, because of higher tax rates and lower other income, the profits might see a slower growth versus the top line.
Okay, we'll watch out for that. Thanks a lot for that. About 1% higher is Asian Paints. Shraddha, to HDFC Bank, and I think we spoke about it in the morning, don't expect too many deviations.
Absolutely, Neeraj. That's what we've been seeing from HDFC Bank over the last few years. The blip, of course, came in the last 1 or 2 quarters owing to demonetization and the farm loan waivers. But broadly, all the operating parameters and growth should come in at a healthy number. Key numbers to watch: net interest income is expected to grow by 20%. Net profit is expected to grow by about 20.7% to 417 crores. So largely in line with the 20% growth trend that has been exhibited by the bank in the last few years. Net interest margin expected to remain stable sequentially at 4.4%. Remember, the savings deposit cut had come in this quarter itself. Amongst the other parameters, loan book growth again expected to come in at about 22%, owing to growth in working capital demand and also the retail portfolio, especially due to the early festive season. Asset quality is usually not a concern for HDFC Bank, except for the June quarter, which was a blip where the gross NPA number had shot up about 19 basis points to 1.24%, mainly due to the agri slippages. So that's one aspect to watch out for. The CASA share in the June quarter had also dropped by a big 4 percentage points to 44%. So that's another interesting trend to keep an eye out for. And largely, we'll also be watching the trends in digital banking and the overall balance sheet growth commentary from HDFC Bank, but stable numbers, yes.
Okay, stable numbers from HDFC. Will it be stable numbers from Infosys, or the market doesn't quite care about numbers, Agam, this time around?
Well, it really doesn't, Neeraj, but if you consider the numbers, in terms of expectations, it is going to be a very quiet quarter, like we saw in case of TCS and Wipro. So let's start off with the expectations. When it comes to Infosys, we're expecting about a 3.5% growth in terms of dollar revenues, expecting another 3.3% growth in rupee terms when it comes to the top line. EBIT margins expected to come off to a certain extent, at around 23.5%, and consequently profits because of that could grow by just as much as 1.3% sequentially. But the big question here, of course, is on the guidance. Now, the management has given a guidance of around 6.5 to 8.5% in terms of dollar revenues, constant currency, for this entire year. However, a lot of analysts out there, this is including analysts from UBS, Kotak as well as IDFC, do suggest that there could be a downward revision of the entire range itself. Moving in, what are the factors that can bear down on this quarter's numbers? Firstly, of course, softness in BFS and retail segment. We could see some margins pressure on account of pricing as well as a lot of wage hikes, the larger wage bills which will be effective from July, which may bear down on margins. But perhaps the most important question this time around will be, and a lot of analysts will be keeping an eye on, the strategy and how Infosys and its management charts strategy out, but also its update on CEO hunt, because this morning we had a newspaper which suggested that Infosys could very well announce a new CEO today. And of course, finally, client spending and budgets, that is something that has always been on a lot of analysts' mind. On the whole, we're expecting a muted quarter, but all eyes will be on strategy, the guidance, and perhaps more importantly, the CEO announcement.
So that, Agam, well, just a quick check on the markets. ONGC is the top gainer on the index, followed by Tata Steel, and Yes Bank, interestingly, ahead of the numbers, is starting to perk up about a couple of percentage points. I think the one more in the large cap space is Ultratech, which continues to rise and shine. So up another couple of percentage points today is Ultratech Cement. That's pretty much what's happening in the large cap end. Bharti Infratel is corrected, so that one is off, and as is HCL Tech ahead of its numbers today. But I think the key more is Ultratech on the large cap space, and as I said, Delta Corp at the mid cap space, to my mind, is one of the key movers in the session today. But with that, it's a wrap on this leg of Indian Open. Up next is the FNO show. Do stay tuned for that.
Are we live?